Hello, everybody. Happy Sunday. As I put my daughter to sleep, I ran down to go make a video for my channel members. As you know, I made a video last week talking about starting a brand new series specifically for my channel members, not only talking about, but actually showing, doing, and tracking a wheel strategy portfolio when it comes to options. This coming Monday is going to be the first such trade that I'm doing, and I was able to find the stock that I want to do a wheel strategy with. I also have an alternative stock for people if you want some ideas. Before we go any further, let's explain what a wheel strategy is. A wheel strategy is simple. Think about a wheel that goes round and round. You have two components of a wheel strategy. You have a cash secured put and you have a covered call. A cash secured put is quite simple. You are selling somebody a cash secured put, which means you are telling somebody at a certain strike price, you are willing to buy shares of a certain stock. And strike price, all that means is the price that you're willing to pay for such stock. There's an expiration date, which can be whatever you want it to be. In my case, it's going to be 1 week. Don't get confused. I'm going to show you guys examples. I just wanted to explain how everything works. When you sell somebody a cash secured put, you are putting money up for the said stock, and you have to have the money in the account. If the price of the stock hits the strike price, you must purchase 100 shares of the stock. For doing this, you're collecting something called a premium. Now, if the price of the stock does not hit the strike price, then you're good. For example, if the price goes up for the week and the price does not go down of the stock, you don't have to buy anything and you just collect the premium. If you get the strike price that hits with the stock and you have to get assigned, which means you have to buy the shares of stock, you now own 100 shares of stock. That's why it's very important when doing the wheel strategy to make sure that you specifically want that stock. The wheel strategy works if you are bullish or neutral on the shares of stock. It doesn't work if you are bearish on the stock. Where the wheel strategy starts is once you actually get assigned and you own 100 shares of stock, you can now sell a covered call on the same 100 shares of stock. When you sell a covered call, you are taking the opposite and telling somebody, hey, if the price of my stock hits a certain strike price, I will sell you my shares of stock at a certain date, expiration date. If a stock hits a certain price, the strike price, then you must sell them 100 shares of stock. If the price does not hit the strike price, then you do not need to sell them and you just collect the premium. The premium collected in the put and the premium collected in the call offset your cost basis. I'm going to show you an example in just a moment. When employing the wheel strategy, you don't really care about the long-term strategy here, although you want stock that you are willing to hold for a long time. You also want a stock to appreciate, but you are not so concerned about the appreciation of stock. You are more so concerned with making a weekly synthetic dividend or a weekly salary when it comes to doing the wheel strategy. There are other things that you can do if you are getting close to assignment, which we can cover if that happens in some of my plays. But for all intents and purposes, you are putting up money, telling somebody, I'm willing to buy your shares at a certain price if the price goes down of your stock. And if that happens, you are then telling somebody, I am willing to sell those same exact shares if the price of shares hit what I'm willing to sell it at. And you collect premium both ways, making yourself a nice weekly salary. Last week, I opened up something called a Roth IRA with Robinhood. This Roth IRA is tax-free. A Roth IRA is quite simple. If you make $100,000 a year or whatever number, it's arbitrary, you open up a Roth IRA, say in this case for $6,500. The $6,500 does not get deducted from your yearly salary, and you still have to pay taxes on the full $100,000. In a traditional IRA, you can offset the amount of money you're putting in an IRA against your yearly salary. Because of this, you already paid taxes on your money, and when you retire at 59 and a half and start taking your money out of your Roth IRA, it is completely 100% tax-free. And for all intents and purposes, you can take out your initial investment. Let's say you open one up for $6,500 and you don't get fined. The reason I'm saying $6,500 because $6,500 is the most that you can contribute every single year. There are some nuances to this if you make a lot more money, which I won't get into because I'm going to assume that everybody watching this video can contribute to a Roth IRA at a $6,500 limit. I opened up my Roth IRA in Robinhood. Robinhood Gold is giving you a 3% match. If you need Robinhood, I have a link to Robinhood down below. You get a free stock, I get a free stock. I get like $5 out of it from a stock. So if you want to use the link, go ahead. If you already have a brokerage that does this, then you don't need to. Now that we understand what a wheel strategy is, I'm going to explain to you the stock that I'm picking, and then I'm going to give you a second stock if you can't do the stock that I'm talking about. If you've been following me for a while, you know that I have PayPal Leaps. So the stock that I'm going to be picking is actually PayPal. I wanted to buy shares of PayPal, but instead of buying shares of PayPal outright, I might as well do a wheel strategy because I'm not dying to buy the shares. But if I have to buy the shares, I might as well collect a premium to offset the price and reduce my cost basis of the actual stock. And again, don't worry, I will give you guys an example in just a moment. I'm just talking to explain it right now. The current price of PayPal is $61.19. I find the next support level to be $61.40 while doing technical analysis. You could see a screenshot right here. There's something called a 20-day, a 50-day, a 100-day, and a 200-day moving average, and that's exactly what it is. It's the average move of the stock for 20 days, 50 days, 100 days, 200 days. When doing technical analysis, in the broader sense, 20-day is immediate bullish short term. The 50-day is short-term bullishness. The 100-day is mid-term bullishness. And the 200-day is long-term bullishness. Hence, 20 days, 50 days, 100 days, 200 days. The current price at $61.19 is higher than the 20-day at $60.96. Almost at the 50-day, which is $61.21. Let's just say that it is. And above the 100-day, which is $60.21. It's actually extremely close to the 200-day, which is $61.30. And PayPal is showing strong support at the 100-day moving average, which you can see by these two mega candles, both red and green, where we just bounced off that 100-day moving average. Being above the 20, the 50, the 100, and moving above the 200 is all bullish when it comes to share price. Technical analysis is just another tool in the shed. It is not the be-all, end-all, but I thought since you guys are channel members paying me $3 a month, I want to give you as much as I possibly can with my thesis and explain to you the thought process of why I am picking PayPal. Besides for this, there's something called a MACD. Don't need to know what it is, but let's just explain it really fast. This is a screenshot down below. You're going to have a blue line and you will have an orange line. The blue line is the MACD line. The orange line is the signal line. When the blue line crosses the orange line or the MACD crosses the signal line, this is bullish. And we actually have the MACD crossing the signal line, so that's bullish. When the MACD crosses the zero line, this is bullish. As you can see, the MACD or the blue line crosses that neutral zero line. Finally, the signal line is about to cross the neutral zero line, and that becomes bullish. So we have 2 out of 3 bullish signals when it comes to the MACD, and we have 2/3 out of 3/4 bullish signals when it comes to the actual price and the moving average. For all the reasons I just mentioned, this makes my decision easier to invest in PayPal, putting a cash secured put, because I don't want the price of PayPal to go down. I actually want the price of PayPal to go up, and up in a very incremental movement. Not a lot, just a little, so that I don't get assigned and I just collect my premium. Let me explain to you how this works now. And then I'm going to show you an actual example. When you're doing this on Robinhood, there's going to be a couple of different strikes that you can pick. You should be picking, and whatever you pick is up to you, but you can be really, really aggressive and pick really close to the money, which would be $61, or you can be a little less aggressive and pick one at $60. What you're saying is, if the price of PayPal by the end of Friday hits $61, you are willing to buy 100 shares. Or if it hits $60, you are willing to buy 100 shares, which means you need to have either $6,000 or $6,100 in your account in order to do this play. If you don't have $6,000 or $6,100, don't worry, I will give you a plan B, and then I will give you a plan C and D if you would like. But for anybody that does have $6,000 or $6,100, I think PayPal, at least for me, would be the best possible play, and I'll explain to you in just a moment. If you click on these, you're going to see something called a delta. On the $61, there's a 45 delta, 0.45, and on the $60, there's a 0.29 delta. What that means is there is a 45% chance and 29% chance, roughly, for the person that is on the other end of this contract to win. So that means you have the opposite. So at $61 with a 0.45 delta, you have 55% chance of winning. However, at the $60 strike with a 0.29 delta, you have roughly a 71% chance of winning. Finally, you're going to get a premium. The premium is 100 times the premium price. So on the $61, you have a 0.81 cent, and on the $60, you have a 0.44 cent. That then becomes times 100, which you get $81 and $44. Now, if you are doing the math, $81 premium out of $6,100 that you got to put up is roughly 1.3%, while a $44 premium of roughly the $6,000 that you got to put up comes out to around a 0.7%. What exactly does that mean? That means that if you are doing this in a week, depending on what strike price you are comfortable with, between the 60 and the 61, you will be making around 0.7% to 1.3% on your money for 1 week. If you convert that for the whole year, that's like a 50% return doing the wheel strategy. It doesn't always work like this because you can get assigned market volatility, what goes up, what goes down, so on and so forth. You can be as aggressive or as passive as you want. You can figure out strike prices yourself. As you can see, there's a lot more strike prices when you play around than 61 and 60. You can go as low as you want, but you collect less and less premium the lower you get, because the chances of that happening is slim to none. If you like a coin flip, pick $61. If you want more advantage on your end, pick $60. The thing is, are you willing to buy the shares if the price hits? I am inclined to do a $61 strike because I want to be as aggressive as possible, because I don't mind owning PayPal. We'll see what happens on Monday. I might end up doing a $60 call just to give myself a little bit of a buffer, because like I said, the 100-day moving average, which is right around that $60, it just bounces off. So probably you'll be a lot safer with the $60 call. But instead of making 1.3% on your money, you're only going to be making around 0.7% on your money, which is absolutely ridiculous because we're talking about a 1-week time frame. If you don't have $6,000 in your account, that's okay. My second pick, which I was about to do, would have been TFC, or Truist Financial Corporation. It's a bank. I like Truist. I hold it. I sell covered calls on it weekly. And Truist would be my second choice. Truist is currently trading at like $28 a share. So you need to put up around $2,800 in order to do that. You have enough knowledge, you have enough skills to figure this out yourselves now. You can go on Robinhood and see the delta. You can see the volatility. You can see the premium. You can then calculate the percentage that you would be making. If you don't like PayPal and Truist, or you don't have enough money to do it, the next choices would be Palantir and SoFi, because you need a lot less. Remember, Palantir prices right now is like $14 a share, so you need $1,400 to do one contract. And SoFi is around 8 and change, so you would need around $830 to do one contract. I don't want Palantir and I don't want SoFi because they're not at 52-week lows and they're extremely volatile. PayPal is at a 52-week low or near it, and Truist is near a 52-week low. So for me, PayPal and Truist would be a lot better in choices, and there's a lot less volatility, which means the price doesn't fluctuate as much. Truist gets a plus because it's a dividend stock as well. Guys, I hope this makes sense. My point of this portfolio is only to do essentially options. I'm not going to be trading any stocks. It's all going to be for options. The only time I'm going to be trading stocks is for the purpose of options. Cash secured puts, covered calls, and hopefully I'll have some dividend stocks in the future where I'm going to be making dividends as well. The point of this account is strictly to grow it. And hopefully in 1 year from now, this account is going to go from $6,500 to $10,000. That's my goal. I want this to be $10,000 in exactly 365 days from now. And I want to just generate income because that's all I'm thinking about. I already have a lot of shares of stock and options of a lot of various stocks. I just care about long-term sustainable income. I'm not a financial advisor. This is purely entertainment and education. If you have any questions, please ask. The purpose of this video is not for you to blindly follow and do what I'm doing. That's not what I'm saying, and I don't want you to. I'm literally telling you, this is not financial advice. Don't do exactly what I'm doing. It's to give you an idea and to make your mind work, to show you if I could figure some shit like this out and any Joe Schmo can figure this shit out, there's no reason why you can't figure this out and make your money work for you. Make your money print more money. That is the goal of wealth. And at the end of the day, when you own stock, you don't have to sell your stock. Rich people do not sell stock. Rich people borrow against their existing portfolios and don't have to pay taxes because they never actually sold their stocks. Another way that you don't have to sell taxes is trading in a tax-deferred account like a Roth or traditional IRA. And there are many other ways to do this. I made a video about this. If you guys want to check that video out, click on this link over here where I explain all of these retirement accounts. Thank you very much. And again, if you have any questions, please ask. Have a great day. Happy trading on Monday.